Good morning, traders and investors. Roger Scott here, senior strategist for The Trading Pub. It's Wednesday. It's October 4th. My watch finally agrees with me today. My calendar was set off. I was on a different date yesterday. It's about 7:54 in the morning. The market's going to gear up to open up in about an hour and 36 minutes to be as specific and exact as I can with you. Before we begin, make sure to subscribe to my YouTube channel. It's the Roger-Scott YouTube channel. Just go to YouTube, go to Roger-Scott. You'll find it there. I upload these videos there at about 8:30 in the morning, about 35 minutes from now. You'd be the first one to get it there. Second of all, subscribe to my Telegram group. Go to rogerscott.com/Telegram and click the link after you subscribe to Telegram. It'll join you. Free trades, pictures of my furry assistants, stock tips during the day, lots of good stuff. We've got over 2,200 people loving it. Most importantly, VIP room. I still have left it open for the time being. You're welcome. Link above or below this video. It's like the real second portion to this video. It's happening at noon today, Eastern time. Link is above or below this video. All right, let's get into all of the juicy details, and I'll repeat all this before we end today. And you can also email me at roger@rogerscott.com anytime. All right, Nasdaq is up. The Dow is up a little bit. This is very random. I wouldn't get too excited about this, but one of the reasons you're seeing this right now is because if you look at the futures market, which we'll look at in a quick second, you will see that the bond market is actually up today, not down. Here's a 30-year bond. It actually is opening higher, which is one of the biggest reasons the market fell apart last few days is because bond yields have been going higher, which is really bad for a lot of type of stocks like consumer staples, real estate, utilities. It's very, very bad. Very, very bad. So if the bond market continues falling, it's going to be terrible. But I think we're overdone. I think we're way, way overdone. I think this is this was a big bloodbath, but it's finally over. I believe bonds are going to start rallying, and it's going to help the market sustain some upside movement. We don't know how much just yet. We'll talk about that in a minute. And if you look at the TLT, you'll see the same thing. Here we're looking at the bond, 30-year bond, and here you're looking at the TLT. You see how they look almost identical? This is why I look at TLT instead of 30-year bond, because their price action is literally almost identical to each other. I mean, they follow each other. Today, we've got some good data, a lot of data. We've got petroleum status report. That's coming out at 10:30. Keep an eye on that because energies are bleeding right now. You've got the Institute of Supply Manager Service Index. This will give us an idea of if inflation is creeping into the Institute of Supply Management. The Producers Managers Index is coming out today at 9:45. Interestingly, notice most of these reports are coming out after the market opens. So we'll have to carefully watch the market, especially the first hour. Don't recommend trading the first hour today. Do not trade the first hour today. We got the ADP report. This is a private report that reflects on the employment situation, but I'll tell you the truth. It's been really wonky. It hasn't been on par. It's been moving the market, but it really hasn't been accurate at all. So there's a lot of Fed data the market's going to have to digest, especially the first hour. My recommendation is to mark levels on your charts the first 45 minutes of the day and then start making your moves after that's done, okay? Very, 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 very important. There's no major earnings today. We had MKC yesterday. The stock fell apart. We had COM. It wasn't really doing anything today. You have Tilray and a couple of other stocks. Tomorrow, you've got Lamb Weston, Conagra, and Constellation. So tomorrow, and today, we're really going to keep our eye on consumer staples because those are all consumer staple stocks. And as you can see here, consumer staples have been mimicking the bond market. Look, consumer staples and where is it? Consumer staples, bonds. Consumer staples, bonds. So if bonds can get a lift, it'll give consumer staples a much, much needed lift. Let me talk about global economy, and then I'll get into the levels with you. Levels are very important today because we are at crucial levels on the SPY, the Dow, and the Nasdaq, and I want to go through that with you and then get into some sectors. So Treasury yields found a footing so far. They're up this morning. Let's see how they do after the news announcement, after these reports come out. They're holding on so far. They may rally. If they rally, I'm expecting higher prices on consumer staples, all real estate, all the stocks that have been moving lower. So if they move higher, we can expect some upside in the market. Again, we've got ADP employment report in just a little bit, in like 15, 20 minutes. S&P and blue chips fell to a 4-month low. I could always tell this happens because I've got a lot of clients who don't take shorts. And then I get emails saying, Roger, my account is down. I've been cherry picking trades. Don't. It's not a good idea. And I've been short quite a bit, and I've been telling you the market's due for a fall. Labor market showed yesterday that the JOLTS job openings report was amazing compared to expectations, which means employers are hiring. And if employers are hiring, that means the economy is pretty resilient, which means the Fed can continue raising rates. And that's why the market dropped like a rock yesterday. Bostic said yesterday central banks should hold interest rates at the elevated level for a long time, and I think they will, to bring back inflation. I'm not in a hurry to raise, but I'm not in a hurry to reduce. Well, they've done a lot of raising. They want to see what happens now. They're not telling you that, but that's what they're doing. There's a 37% chance of a rate hike in December. I would have expected this number to be a lot higher. If this number starts moving a lot higher, it's going to impact the market because this is what's priced into the market right now. And I think the odds of them raising rates in December are a lot better than 37%. I would say they're at about 55% right now. So, November, no, but December, yes. Again, you've got non-farm employment data today. That's supposed to come in at 153. It's been really wacky. You've got Institute of Supply Managers, non-manufacturing purchase managers index. That's coming out. Try to say that 4 times fast without abbreviating it. Institute of Supply Management, Producers Management Index. Oh boy. You've got global PMI, factory orders. This is going to be very important for the Fed. They look at all these little breadcrumbs. You've got crude oil inventories. Crude oil's been taking it under the chin. We're going to talk about that in a minute. Europe is not doing so great. They're a little higher. Gains in utilities. Media stocks are leading the overall market higher. Utilities and media stocks. Don't ask. No relationship there. Probably because bonds are moving a little bit higher. Interest rates are moving a little lower. Survey released on Wednesday showed that the Eurozone economy is contracted in the third quarter, with demand experiencing its swiftest decline in almost 3 years in September, as indebted consumers curtailed their spending due to rising borrowing costs and higher prices. Europe is not doing well. China is closed for a holiday. Japan closed sharply lower, lower, and hit more a 4-month low today, just like the Dow. They're watching Wall Street. Treasury yields climbed to a fresh 16-year high and a prospect of higher rates. Not good, not good. A lot of stocks, Apple fell. They were downgraded. Not so good. Palantir broke the 50-day moving average. We're no longer in that stock. CalMine plunged 12%. Not so good. Now, technically, the consumer staples looks like it's, for now, it's a little overdone. It's a little too far away from the 8-day EMA. It looks like it needs to come back up, bounce back up a little bit up here. Don't know if it's going to turn around. Energies have not been doing so well, but they look like they closed near the high. And if we can get a higher reading today, we may be able to get some upside, because right now, they're just not looking all that great. They're like right here at the bottom. There is some really good support for the energy market, and I believe with the economy still being in their tumultuous period, I think energies are going to bounce off. But they may come down all the way to the 200-day before they bounce off. So we're either going to stop here or we're going to stop here. But I don't think we're going to break down. We're not in a position. Nothing really has changed with the energy market, and the economy is not slowing down. It's actually gearing back up. We're near the end, not the beginning, so there's less chance of a recession. There's more high chance of a soft landing, and energy prices are going higher. Technically, again, I want to see if we stop at the at yesterday's low, because if we do, we can catch a bid and go higher. Matter of fact, yesterday we bounced down, but then we started heading higher intraday, and we actually closed near the upper end of the range. Just wanted to show you yesterday. We went down in the morning, right? This was yesterday. Yeah. No, this was not yesterday. This is yesterday. That's what I thought. We opened down, and then we rallied towards the high of the day. So if we can start going higher and break above 89.45, that would be very instrumental. I'd like to see us break above 89.45 and then break above 90 level. Now, on the SPY, this is important. Listen and pay attention. We're right now at the 200-day moving average. If you look here, Let me just go across right here. You see that? See what I'm doing? I started on the left. I started on the left. I could have started on the right and went backwards, but I started on the left because I already knew this. I'm cheating. But notice where the line goes, right? Why isn't this highlighting? Okay, here we go. Let's make this red. There we go. You see how we're right at the 200-day moving average and how support is right there? There's a hell of a lot of support there. I'm going to put myself on the line here. I do not think we're going to break the 200-day moving average. If we do, I think we're going to break it, hit some stops, and come back down. But there's a hell of a lot of support here. I mean, a lot of support around here, a lot of here. So for this to break down, we would have to take us all the way down to here. I don't know if that's going to happen. I'm not expecting that to happen, especially when we're at the 200-day. We usually bounce at the 200-day, but we'll see what happens. Looking at the QQQ, we are not nearly there, and we are actually still above the first. We're trying to break the first support level that I gave you guys about a week and a half, 2 weeks ago, maybe even more, and we're now trying to flirt with the second. Tech is holding up a lot better. Matter of fact, let me show you something over the last 3 weeks. Look at what's leading. Communication, technology, QQQ. Retail, there's a lot of QQQ. There's a lot of that in the QQQ. Technology, QQQ. I mean, the only thing is consumer discretionary, but look, communication is number 1. Technology is number 4. And QQQ, I mean, this is very, very positive compared to the blue chips. All the blue chips are down here except for consumer discretionary. Now, what about this last 5 trading sessions? Well, technology, retail, QQQ, communication. It tells you everything right here. Now, again, consumer discretionary, over the last week, it's still in the middle. Utilities, real estate, financial, home builders, consumer staples, interest rates. Right there. So the QQQ is doing a hell of a lot better, and it's actually not even bleeding as hard. Let's look at chips. So to me, the market is not as bearish as it appears because the technology sector, look, choppy. QQQ, choppy. Let's look at XLK, excuse me. Probably choppy too. Yeah, see, choppy, not as bearish. Just now coming through that red line that I drew a while back. So we're nowhere near the 200-day moving average, and it's holding pretty good here. If it breaks, we're screwed, but I think we're going to hold for now. So I'm actually expecting a bounce because most of the sectors that are leading are doing a lot better right now. They're not doing worse, they're doing better. Now, I promised to give you a long and a short. It's Wednesday. Let's do that. Let's see which stocks are breaking out right now. So let's take a good look here. Well, let's take a look at CBOE. All right, look at CBOE, how well it's been holding on. Virtually everything's been pushing back. But CBOE, look at this thing. Let's put a relative strength on it. This stock looks amazing right now. Look at SPY in the last 2 weeks and look at this baby. How about we look at the last 3 months? SPY. How about the last 60-minute bars? Flat down. I like that. How about the last 30-minute bars? Up, down, and just now turtling back up? How about yesterday? Down, 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 and then as it goes down further, it comes up. I like this. I like this a lot, actually. So I would be buying options right now on the CBOE. I would be going about 9 days out. Earnings. Oh, we got some time with earnings. I would be going to the 152.50 or the 155. Yeah, the 155 looks good right here. The spreads are a little wide. You may have to go to the monthly. Yeah. You may have to go to the 155 or 152.50. But again, it's only 16 days out, and you'll get better liquidity right here. Here's good liquidity, 157.50. You can get good liquidity with that right there. Although I don't like to go that's a little too far out of the money. I'd prefer to go a little bit in the money, like the 155. Now, to the short side, oh boy, where do we stop? Where do we start? Let's look at 50-day lows. And now, actually, I got a better idea. let's take a look at my S&P 500 and the weakest stock in the S&P 500. All right, here we go. Here's some really good choices. Oh boy. MKTX, this looks really weak. ILMN looks really, really weak. And Etsy looks really, really weak. So does EL. EL, Etsy, Coach, ILMN, and MKTX. I gave you plenty. Now, folks, before I let you go, today's the day. Today is the big day. I finally reveal a twist I discovered in the options market. And with this twist, a pricing mismatch, we can turn a 1% move in the stock price into double or even triple-digit returns. Leverage, baby, leverage. Now imagine $10,000 starting investing, growing exponentially over the next 10 years, thanks to this little quirk. Heck, you could even start with just $1,000. Sound intriguing? I cannot wait. Dive in with me live. Uncle Roger at 1 p.m. Eastern Time today. Click the link below this video and unravel a method of finding dirt cheap options together with me. Both of us at 1 p.m. Eastern Time, right after VIP room. Do not miss out. I haven't done this presentation since last October. It's almost a year. You don't want to miss out, and I'll talk to you guys later. Bye. Have a great, great day. Remember, Roger at rogerscott.com, Telegram, YouTube channel, VIP room. Oh, yeah.